Most founders spend years chasing a single moment: the meeting, the pitch, the email, the one message that says we're interested in investing. For many startups, that moment feels like crossing the finish line. Investors are paying attention, the idea is validated, the future suddenly feels closer. But here's the reality most people never talk about. The real story doesn't start when investors show interest. It starts the day after. Because investor interest changes everything. It changes how founders behave. It changes how teams think. It changes how decisions get made. Suddenly, the startup isn't just building a product anymore. It's performing. Performing for investors, performing for valuation, performing for momentum. And that shift, the one nobody prepares for, can quietly shape the future of the company. Today, we're exploring what really happens after investor interest appears. Not the headlines, not the pitch decks, but the quiet, subtle, often invisible changes that determine whether a startup actually succeeds. Because the biggest startup mistakes rarely happen before funding. They happen after attention arrives. Let's start with the moment every founder remembers. The moment an investor says, "We'd like to continue this conversation." For founders, that moment feels electric. Months, sometimes years, of work suddenly feel validated. Investors ask deeper questions. They want financial projections. They want product demos. They want to understand the market, and the signals feel positive. Founders start imagining what the future could look like: a funded product launch, a growing team, a bigger market presence. At that moment, everything seems aligned. The vision feels real, the assumptions seem solid, and the decision to pursue investment feels obvious. At the time, it makes perfect sense. But what few people realize is that investor interest doesn't just bring opportunity. It also introduces new pressures that didn't exist before. And those pressures begin quietly. The day after investor interest appears, everything still looks fine. In fact, it often looks better than before. Founders feel energized. Teams feel validated. Momentum increases. Suddenly, people start saying things like, "We're getting investor traction. We're talking to funds. Things are moving." And in the short term, those signals are real. Investor calls happen. Meetings get scheduled. Pitch decks get refined. Founders start imagining the future version of the company. But something subtle begins to happen during this phase. The focus of the company slowly begins to shift. Before investor interest, the startup was focused on one thing: solving a real problem. But after investor attention appears, the startup begins balancing a second objective: looking investable. And while that may seem harmless, it can slowly change how decisions get made. This is where the invisible shifts begin. Because investor interest introduces something founders rarely expect: expectation. Investors begin asking bigger questions. How fast can you scale? What does this look like at 10x? How large is the opportunity? And those questions are important, but they also create pressure. Pressure to show growth, pressure to show traction, pressure to show momentum. Founders may start accelerating timelines. Features get pushed faster. Roadmaps expand. Teams grow sooner than expected. None of these changes feel wrong at first. In fact, they often feel necessary. After all, if investors are interested, it must mean the company is ready for the next level. But what's quietly happening is a shift in priorities. Instead of building the right product, the team may begin building the impressive product. Instead of focusing on real user validation, the focus shifts toward investor perception. These changes are small, subtle, almost invisible, but over time they compound. The consequences of these shifts rarely appear immediately. In fact, the company may continue growing. Funding may even arrive. But months later, something unexpected happens. The product feels misaligned. The market response is weaker than expected. Growth slows. Suddenly, founders begin asking, what went wrong? But the truth is that nothing failed overnight. The challenges were already forming much earlier. They started when the company began optimizing for investor expectations instead of real market validation. This is why many startups struggle even after raising capital, because capital amplifies decisions that were already in motion. If the foundation is strong, funding accelerates success. But if the foundation is unclear, funding accelerates confusion. The reason founders miss these signals isn't incompetence, it's psychology. Human beings are naturally optimistic about their own decisions. When investors show interest, it reinforces the belief that everything is working, and that belief makes it harder to question the direction. Several cognitive patterns appear during this phase. Overconfidence, because external validation feels powerful. Confirmation bias, because founders begin noticing signals that support their vision. Process blindness, because momentum makes teams move faster than they reflect. And emotional investment, because founders deeply believe in what they're building. None of these are flaws. They're human, but they make it easier to overlook small changes that slowly shape the company's trajectory. Experienced founders, operators, and investors think about investor interest differently. They don't see it as validation, they see it as a new stage of scrutiny. Instead of asking, "Are investors interested?" they ask, "What will this company look like after investment?" They monitor different signals. Are customers truly using the product? Is the problem still clearly defined? Are decisions still driven by user feedback? Or are they starting to drift toward storytelling for investors? Experienced builders know something important. Investor interest is not proof of product-market fit. It's simply proof that the story is interesting, and stories can be powerful, but companies survive on reality. So what's the better way to think about investor interest? Simple. Plan for the day after. Before pursuing funding, founders should ask one important question. If investors become interested tomorrow, what will change about how we operate? Will we build faster? Will we hire earlier? Will we expand our vision? And more importantly, will those changes actually improve the product? Or will they simply make the company look more impressive? The founders who succeed long-term understand something simple. Investor interest should support the mission, not redefine it. Most startups don't fail when they raise funding, and they don't fail when investors show interest. They fail in the months that follow, when subtle decisions slowly reshape the company. Because success in startups is rarely about a single moment. It's about what happens after the moment passes. If this episode changed how you think about investor interest, that's exactly the goal. This is the day after. And next week, we'll explore what happens after a startup hires its first team. Because the biggest changes in companies rarely happen during the headline moment. They happen quietly, the day after.